Okay. Hello, everyone, and I want to welcome an option specialist. We finally have one, and so Nikhil Jaisinghani is going to tell us everything that he thinks that we should understand. If you're a quant, if you're an undergraduate, if you're a graduate student, if you're in the field, whatever, I think it's time to dive a little bit more into details. I mean, without getting too complex, but really understand what is it about options that's interesting, the philosophy behind the options. And Nikhil joins us out of Virginia. So, Nikhil, welcome. And further ado, tell us a little bit about yourself, and then tell us what we should know about options.
Well, thank you, Patrick. I appreciate it. And I appreciate the opportunity to be on the show. It's really important to me to outreach and to share some basic fundamentals on options with traders and anyone interested in trading options, because I think there are a lot of not only misconceptions, but I think there are a lot of tendencies when people learn about options that can be dangerous and impact their ability to use them profitably. What I see a lot of times are people jump into options. They learn what a call is, they learn what a put is, a right to buy or a right to sell a stock at a certain price, and they go right from there into trading without coming up with a fundamental philosophy. If you were investing in stocks and you said, look, at the end of the day, I have my paycheck, I had my expenses, I have some money left over. What do I do with it? I'm going to put it in the stock market. That's kind of the basic philosophy. And the reason is you have people working within these companies that are trying to grow those businesses, trying to make them more profitable, and you get to participate in that growth, right? So what is it in options that gives you that same fundamental philosophy on why you're going to make money investing here? And I don't think a lot of people have that going in. And so what they do is they use options as a way to gain exposure to a thesis. I am better able than the market to predict the price of some stock, X in the future. And I can either predict that it's going to go up more or down more than the market expects. I'm better at the market than predicting that. And so options become a way of gaining exposure to that thesis. But the truth is, in the end, we're usually not very good at doing that. The market is in aggregate pretty smart, and we're going to beat it about half the time and lose to it half the time. And so if your thesis, if your strategy is based on you being able to out predict the market, you're just not going to make money that often enough to have a really profitable strategy. And so I think people who used options tactically, while it seems very natural to use them that way because they seem designed to do that, um, it's not a profitable approach to options unless you're particularly gifted. And again, I'm not that gifted, and I think most people aren't. And I think it's just important to put that out there. The second thing people do, which is, you start reading about these complex strategies, iron condors and spreads and calendars, and someone was talking about a double diagonal to me a few days ago. And I think people they look at them, they seem complicated, and they say, "Hey, I'm going to do something sophisticated, and I'm going to start trading these things, and I'm going to make money that way." But they don't know why. And again, if you don't know why, you really don't have a reason to believe that they're going to make money for you. And so the third thing, and this is something that either happens intentionally and sometimes even worse, unintentionally, is people take leverage. And that, when you're right, it's great. When you're wrong, it's really horrible. And people get, there's a lot of pain that comes with that. You approach that Kelly criteria pretty early, where you're taking on more exposure but getting less return as a result, and that's really painful, I think. So those are the three things I think people are inclined to do that I think they should.
So it seems to me you're advocating more like a risk management approach to options. Because what you mentioned something, and I'm reading this what I read this book, and I'm always using it. This fantastic. Well, you can't see it, but it's basically the one called the Chaos Kings, and it talks about Spitznagel, and his approach with the universe. And basically, it says that the gains from Universa, which is what, 105% per year, and of course, culminating in 4,000% during 2020, the games came entirely without anyone at Universa making a single prediction about the direction of the market, which is exactly what you're saying. Is that I think is key. Do not try to predict the market because you're
Yeah.
right. You're not going to get it every single time.
Yeah, and if your strategy relies on you being right more often than you're wrong, and you're right as often as you're wrong, you just end up not making any money at the end of the day. So I think that's a great quote, and I'm going to read that book when we're done with this because that sounds like a fascinating read.
And I mean, this is obviously Universa and Spitznagle, and obviously that ties into to Taleb Nassim and to Mandelbrot. And the idea is really to say that no, and unfortunately, people want, and I've noticed that more and more, people want prediction. Tell
Uh-huh.
me what's going to happen. Instead of education, like understand what's going on, especially
Right.
like it's what's going on today, right, in the market and in the world. You can't predict these things.
Absolutely. Yeah. I mean, maybe there was some bit of foreshadowing of a war in the Middle East, but to have been able to predict with 100% certainty that it was going to happen, that would have been a pretty bold call, and I wasn't making it.
I mean, and you could see what's happening with gold and
Yeah.
silver and the commodities. They say, okay, great. So flight to quality. Everybody
Right.
buy gold. What do you mean gold is going down? What's going on here? Doesn't make any sense. Exactly. Right. So what's your approach then for someone that's coming in
Yeah.
and wants to know, well, then what do I do then if I can't predict
Right.
anything?
Yeah, that's a great question. And so if you're not going to use options as a way of gaining access to your thesis, and if you're just saying I'm not going to have a thesis because I'm not going to outpredict the market, what do you do? And so I think it's important to realize that there are four possible positions, fundamental positions with options. You can take a long call position or a long put position, which are what people often take, but you can also short. You can be the writer of the option. So you're providing the insurance to the put purchaser, for example. And so you can also sell calls. And so that gives you four fundamental positions. And there's reasons to believe that selling puts is a long-term money-making strategy. And I could probably spend a day talking about it, but just at a high level, if you looked at put call parity, which is a rule that says puts and calls for at the money options have to be the same price. It's more complicated than that, but essentially let me just take it from there. Why would a call, which gives you right to participate in the upside, be priced the same as the put, which allows you to benefit from downside when a stock tends to go up? If the stock tends to go up, you should think that the upside has more value. And so that call should be more valuable than the put. But because of arbitrage rules, it's not. And what's happening is that those arbitrage rules are actually pumping up the prices of puts, making it more expensive to buy that downside protection. But if you're on the other side of it, writing the put, you're getting that premium up front and you're getting more premium than a risk neutral framework would tell you you deserve from taking that position. And so that's one reason why selling puts is I believe attractive. And you can also back test it, and that's another easy way to test this theory. And what we see is that selling puts, and particularly out of the money puts, generates a really attractive risk return profile for investments. And so that's fundamentally what we do. I sell puts. I have a fund that I sell puts in. I sell puts. I've been selling puts for years. And that's the basics of it. And you can get more advanced and more sophisticated on top of that. But as long as you know that when you begin, selling puts is inclined to make you money and the other three positions are not, you can at least avoid complex structures that have elements which are money losing. That you at least if you include them in your strategy, you understand why, because they are going to be a cost to your portfolio. So I think that's the fundamental starting point that an options trader, particularly someone getting into options, should understand.
Okay, so let's dive into this. So basically, we're not predicting anything. We have a position, basically. So explain that in maybe more granular. I have a let's say I own Nvidia. What do I do? I sell put on that stock.
I do not associate the strategy with my underlying assets. So in fact, if I owned Nvidia, which I don't, but if I
Hmm.
were to, I wouldn't sell puts on Nvidia. That'd be kind of doubling up my exposure on Nvidia. But what I might do is I might have 50 other tech stocks that I look at, and every day I might be looking at what the options premiums are for that. So let's say there's another tech stock that sold at this, the price of that stock was at $100. Well, I don't want to take full downside exposure, so I might look at a put with a strike price of 90. So that gives me a 10% decline in the underlying where before I have any loss. And I might sell that. So now I've got another exposure, but I don't have to own that underlying stock in my portfolio to take on this position, which is a nice thing. I think when people are selling covered calls, for example, they're only able to sell the calls on the positions they have. Whereas if you're a put seller, you can look really broadly across the entire market and find the more attractive opportunities.
And what's the downside there? Because let's say it moves against you. What then do you have what to
Yeah. Well, yeah, the downside is that if it moves sharply against you, you have sold the right to somebody to they can sell you this asset at a price above what becomes the market price. And so you end up with that obligation in sharp when there's periods of sharp correction.
but
Um,
obviously you need to watch what's going on, right? You don't want to just well, I guess if you have a fund, you watch that for your clients, but if you don't, then you have to make sure you don't let it happen, I guess, or let it
personally,
happen.
yeah, personally, my approach is that I'm going to do this. It's gonna happen sometimes. So when it happens, I'll end up being assigned shares. I'll take a loss on it, and I'm just gonna go back and do the same thing again. As long as I'm seeing that I'm winning more times than losing and making more money than I'm losing, I have a money making strategy, and I'll just put that on repeat.
So basically, you end up owning a stock, buying it at a lower price, basically. So you're kind of taking a loss, but then, right, the stock could move back up at some once you own it.
The price could move back up, or
Yeah,
I could simply sell it,
you know.
accept my losses, and say this one was a loser, and then put my money back to work by selling another put. And if I sell 10 puts and one of them ends up in the money and causes a loss, but the other nine win, then I may have made money on those 10, and that is generating income for me.
So basically, you're generating income. The risk that you're taking is that you may have to buy it at a very low price. So how do you pick those stocks then? Where do you
Yeah,
decide where
that's
to?
That's a great question. So uh, one could decide to look at stocks, only stocks that they like, because in case they get assigned those stocks, at least then they have stocks they want to have. So that would be one approach. I tend to just look kind of broadly across a set of value stocks. Hopefully they've been beaten down enough that they won't decline significantly more, but that's an assumption that's proven wrong sometimes. But what I'm really looking for isn't the stock, it's the premium. How much are people compensating me to underwrite their put? And as long as I'm getting paid enough and I can look historically at the volatility of this stock and say that I'm in a comfortable position here. Again, if I win 8 times out of 10, 9 times out of 10, um, I'm not gonna be great at predicting which ones are losers, but I can say that over time, on average, my positions win often enough by doing this, and if I'm getting enough premium, then I'll make money. And
Okay,
so that's really my approach.
so to make it very simple, you're basically selling puts. So what I'm going to do is I'm going to be generating income, and the worst thing that happens is, well, I have to buy the stock lower than it actually is. So I'm quote unquote taking a loss. Um, Do you look do you look at the what about the Greeks? Which one is important to you when you pick one of those?
Yeah, so that's another thing I think people like to get into with the Greeks. And they are fascinating, but um, they tend to be misused.
Hmm.
And so you can look at, for example, rho, which is the sensitivity to the a change in the interest rates. It doesn't happen all that often, and if it does, it's pretty marginal. So I don't look at that. And theta is the sensitivity to change in time. So the closer you get to expiration, the more that premium declines, faster that premium declines. That's important to know, but I don't know if I need to measure it. Fundamentally I need to understand the concept though, and anyone who's selling options needs to understand that concept. Vega to me is problematic. Vega is based on the it's calculated based on the Black-Scholes model, but the Black-Scholes model has as an assumption in it that volatility is constant. So if you have a model that assumes volatility is constant, you can't use it to calculate the impact of on the price if volatility changes. It's a contradiction in the model. So I don't like Vega. And then Delta, people tend to use delta as a probability of an option being in the money or out of the money. It's really not much of a mathematical background to support that claim. It's correlated, but it's not a great measure, I would say. But you had an interesting guest a few months ago on gamma, which I thought was really interesting. And I love that because it was really a really interesting way of calculating volatility from prices.
Yeah, we're working with this is a new gamma capture, and
Yes.
basically he's trying to it's a new way of looking at it and getting some traction, trying to put it somewhere in, I think he has it on some of the outfits out there. But yeah, so that's interesting what you're saying, because if someone is out there, they don't understand anything about options. You just told them, well, forget the Greeks. Well, not forget the Greeks, but don't don't
Don't obsess over them.
don't obsess over them, because if it was that simple, everyone would be doing it, and there's no easy. I mean, understand them, I guess, if you need to, but don't over obsessed.
Yeah.
Yeah, it's so for someone starting it, you just want to make some income, and obviously, if somebody helps you manage the process, it makes it easier. You don't have to, because the other way, if you're buying or buying options or buying calls, and you have to, that's the you have to be right. Not only you have to be
Right.
right, but you have to be rather quickly, depending how
Yeah.
quickly your option. It's you know
Yeah. You have to be righter. You have to not only have predicted something's going to go up, but you have to predict it's going to go up more than everyone else is predicting it's going to go up, and that can be really tough. And because what you think, if you're a typical intro options investor and you go in, you say, I've got let's say I've got $10,000 to invest. I'm going to put 5,000 in the stock market, 2,000 in bonds. I'm going to take these 3,000. I'm going to buy some calls. Well, the chance of those calls ending up valued at zero is actually pretty high. It's meaning you're about to take a 30% loss on your portfolio, and you may not realize you've done that. And so that becomes that can be dangerous too when people don't quite understand what it is they're buying.
and you know what I tell everyone all the time is that they're making it easy for you to measure your gain or your losses by showing you. I mean, if you go to anywhere, this is how much
Uh-huh.
money you made, this is how much money you lost, this is the potential gain. But I mean, unless when they show you the beta once in a while, no one really tells you the risk that you are taking, like this chance of you losing all of it. You
Yeah.
say, well, I made some money, but how do you know if you got paid for it?
Exactly. How do you know if you got paid appropriately for the risk you took? Yeah.
Well, I made
That's
some money. Well, yeah, but it's like, I tell that to my students, like, it's like you're trying to cross the street. So I tell them, what is your main goal? Because where we are, there's lots of cars, and the campus is on both sides of the street. And I say, what is your goal? Well, to cross the street. He says, no, no, your goal is not to cross the street. Your goal is not to get run over. Because if you get run over, you're never going to get to the other side of the street. So you're looking left, you're looking right, right? But no one tells you in the market really, because if I guess if we were to start telling that to the quote unquote to the people, they would say, "What is this crazy? This is a very risky endeavor." Well, yeah, not everyone gets to pick. Not everyone gets to pick Nvidia and Amazon, and if that's what you're looking for, that's never going to happen for you.
When we watch the financial markets, they tend to show us the winners, and we think that everything's a winner because they don't tell us as much about the companies that have been going sideways for 5 years or declined. Yeah, you hear about the big winners.
I mean, I found them amazing when I watched all of them, really. And I tell that to my students all the time. I say, you have to understand that they want you to watch whatever they're telling you, right? So they want to be, because if they were to tell you, if they were like Mandelbrot with the behavior of markets, which tells you how not to lose any money.
Hmm.
No, I want to know how to make money. Don't tell me how not to lose any. That is the spirit.
Yeah.
And that's why
Well, and
they,
that's why
yeah.
I equate options to knives, and I think I mentioned or you mentioned that earlier, is that if you don't know what you're doing and you pick up a knife and you just start trying to use it, you're going to cut yourself. But if you know how to use it, then it becomes indispensable. Imagine trying to cook without a knife. It would be really hard to do. And options are that kind of similar thing. Once you learn that fundamental philosophy and you understand what risks you are taking and what risks you're willing to take, then they become really valuable in your portfolio. But before you have that kind of that foundation, trying to get into options has as much of a risk of really hurting you as it does helping you.
I like the way you think. I like the way you presenting um, this as being. It could be very simple once you understand it.
Yeah, and you can definitely make it. You mentioned you can have someone else managing it, and the virtue of that is that it becomes more sophisticated. If you are, the downside of options, when you're buying stocks, you can just set it and forget it. You can buy your stocks, come back a year later, and see where they are. I was so jealous of my sister during 2022, and the market was down, almost 20%. And I said, "Oh my God, I can't believe the market." And she said, "Oh, is it down this year?" She hadn't checked in all year. She had no idea. And so I was so jealous of her, but that's something you can do when you have a basic, passive approach to investing with stocks. With options, they expire. So if you're going to sell a put and it expires in a week, 2 weeks, or a month, you have to be back in to put it back on again. And we talked about theta as well. The longer you wait for it to expire, of course, that gives you more time to forget about it for a little while. But it also means that it's declining slower initially in value, and that's what you want when you're selling a put. And so a shorter duration ends up being more attractive, which just means it becomes a more active approach. So you can of course do it as an individual, but the amount of time you want to allocate to it will kind of dictate your returns. And so handing it off to an options investor can help you in generating a kind of an additional or greater return net of fees than you might be able to do yourself.
Yes, and I guess what they will also tell you is that no, you guys are making it too complicated. Just buy the S&P, hold it, and you don't need to worry about it. But I say again, you're focused on the return. But do you know how much risk, like today, which I think you lost 2% in one day,
Yeah.
and then last week I think you lost 1%, and the time of Venezuela you lost another percent, and you lost another percent at the time of the deep seek surprise on a
Uh-huh.
Monday, and
Yeah.
then I mean, and then
Tariffs
the
hurt.
tariffs, that was a thing. So it's not like it's without risk. You just don't understand the
Yeah.
risk,
Yeah.
and you're doing all this for 10% or maybe
Yeah.
15%.
Right.
And if
Yeah.
this is 1999 or 2008 or
Yeah.
1987, then you lose
Then you're years
50%.
away. Yeah. Hmm. No, it's absolutely true. If you're gonna take that approach, you have to be willing to deal with those declines, because they will happen, and they will hurt you have but you have to, if you're committing to it, you're committing to sticking it through those tough periods, and that's really hard to do once you've lost 20, 30, 40% of your portfolio. To stick with it is really, really hard.
And what we know is the retail account tends to sell when everyone else is selling, and then
Yeah,
buys when everybody else is buying, instead of doing the other way around.
yeah, yeah.
Well,
One nice thing about options, though, is that it does, if you're doing it the way I discussed, you're able to get some downside protection. So even if the market's down, you may still make money or may not lose as much money depending on the exact degree of the decline. But it makes it a little bit more palatable to keep doing it the next day or the next week or the next month because your losses will be smaller.
I want to thank you for this time together. This was very helpful. I definitely want you to come back to talk about the other option uh, aspect of auctions that we haven't have time to discuss, but this was very helpful.
Thank you for having me. It was a great conversation.
Great.